Hello, everyone, and welcome back to another episode of the Multifamily Podcast with Veena Jetti. And today we're going to talk about something super important, which is the location. How can we buy in the right place? Especially in these crazy times, I feel like people are a little bit nervous to even start investing. So first of all, how do you choose the location for the units that you are going to be purchasing?
Yeah, so we look at a lot of different factors when we're trying to decide which assets we should go into. The first thing that we look at in location is it a growing area? So if it's a city that has declining population, obviously that's not really great for multifamily outlooks. So I know it sounds obvious, but that's like the first one that we look at. We want to make sure that it's a growing area, that there are new tenants coming in or potential renters coming in that will make good tenants for our specific type of assets. So that means they also have to have a good job, right? So we want to make sure that there's a lot of employers. Now, some sponsors or investors will look for areas that they just know or like, or that are close to them in proximity. We don't do that. Our saying is invest where you make money, live where you want to live. Don't try to make them both unless you happen to live in an area. I live in Dallas, which is a market we do invest into. But we wouldn't if it wasn't a good investment market. So we want to see a diversity in our job sectors. So I don't want to see that one employer is like 30% of the entire city's population, because your business is so dependent on one company continuing to operate and operate profitably that if they don't, or if they move, or if they have a major layoff, which we've seen before, what does that mean for your tenant's ability to continue sustaining and paying rent?
That's right.
So we're always very careful about looking for diversity in job sector. We go into areas that have high job growth and that are diverse in the fields that those jobs are in as well. We also look for the tenant base. The assets we go after are Class B value add assets. So we're really looking for those Class A locations. We're looking for nicer locations. Our assets are typically family friendly. We are looking for young professionals, maybe dinks, double income, no kids will live at our assets. So we really look for assets that can attract the right type of tenant. And we want to make sure that there is stability of income there as well. And that goes hand in hand with the employment. We want to make sure there's a certain level of income too, so that they can more than qualify to pay the rent that we charge.
Gotcha. And you also mentioned that you guys invest on a certain type of buildings. So what type of buildings are those? Yeah,
so we invest in Class B assets. We typically will underwrite anything that's 200 units and up, a minimum of 75 million now. Obviously, we didn't start there, but that's where we are today. And we look for 1980s vintage or newer. And really where we are in the market now, we're seeing 1990s, 2000s, 2010 vintage price about the same as 1980s. So we've really been looking to the newer assets. You have less deferred maintenance, et cetera. So we look for that Class B asset with some value add to it.
And what are some of the reasons why you also look for just Class B? Because you also mentioned that you're looking for Class A kind of tenants.
Yes.
But why would a Class A kind of tenant go into a Class B building?
So a Class A location really is what we're looking for more than a Class A tenant, because Class A is really nice, but the return is a little bit lower because it is such a highly stabilized asset. So in real estate, right, we say it's a risk-adjusted return. The more risk you take, the more reward you get. So the riskier the asset, the more the potential return on it. So we like to kind of be right in the middle where during a recession, Class A tenants can downsize and come into our assets. During a market boom, Class C tenants can move up when they're making more money and come into our assets. So we kind of we're the ham of the sandwich. So
yeah, the most yummy part, right?
Yeah, exactly.
That's awesome. And what are some other of the characteristics that you look for on the building itself?
Yeah, so on the building itself, like I said, year of construction matters a lot. We're looking to see, what are the roofs like? Have they been maintained? Is there a lot of deferred maintenance? Have they been replacing HVAC units? Inside, is there an opportunity for us to do what we call value add by maybe changing countertops to granite, maybe refacing cabinets, redoing the floors? We can go from carpet to luxury vinyl throughout the unit. We can add washers and dryers. We can paint. We just bought an asset not that long ago in Atlanta. I'm not even kidding. It looks like Kermit the Frog painted it because it was lime green. The outside of this asset is like so beautiful. It's easily one of the prettiest properties we've ever owned. But the inside, it was like,
Oh,
how
my
did this
goodness.
happen? Yeah, how did this
Who
happen?
chooses a green?
Exactly. It was lime green, orange,
Oh, wow.
and brown.
Wow.
Which, fun fact about
Yeah.
color psychology, orange and brown are the two least favorite colors that turns people off the most. And so I was like, okay, I don't know what happened here. So we've just started renovating the asset and we've put everything to, muted tones like grays, purples,
More neutral ones, right? Okay.
Because you want to appeal to a really large
That's
demographic. So we look for that kind of value add or lift. There are opportunities on some assets where you could add another building because there's zoning for it, just no one's done it yet. You can also add a dog park. You can add one thing we do right when we go in, and it's not so much value add, but it really makes the place nicer. Residents appreciate it. They know new management is there and that we really care about the asset. We will restripe the parking lot, reface it. Yeah, it's like one of the first things we do is restriping and power washing when we go into an asset. It's like a little lipstick on the asset.
That's right. I mean, because that's the very first thing that you're going to see as a tenant.
The curb appeal, right?
Exactly.
And that's the type of tenant we want to attract. So we want someone to drive by and say, wow, that's a beautiful property. It looks so nice outside. It must be beautiful inside. And that's the goal of what we try to do. So
awesome.
Those are the characteristics.
And it's super cool how you actually think about your tenants first.
Yes.
And thinking about that, what are some of the places such as like stores, or how convenient does a building need to be for you to actually invest on it?
So this is like a little secret sauce.
Oh, okay.
One of the things that we actually do when we're touring properties is we drive to the nearest Starbucks to see how far it is from our asset. So there's an asset I'm actually looking at right now where potentially, hopefully, going to go under contract on it. But you walk out the front door and not even 100 yards, there's a Starbucks. So you can walk to Starbucks.
Perfect.
And the reason why we like Starbucks and we didn't choose like the nearest gas station or whatever is because Starbucks does a lot of research. So it's the same thing with like Costco is another good measure of the area because they do a lot of research before deciding to put a store location wherever they are. So they have hundreds of thousands or millions of data points that they're looking at and they're planning for years before they put one up. So they already know that this is a growing population. This tenant base can support what their business model is. And so we look to those other stores that have done this research ahead of us to see what they saw in their numbers. And another good one too is hospitals. So seeing hospitals or physician practices growing in a certain area is always great because they're looking for a certain insurance mix for the people that their practice is going to service. And so those are usually people with insurance who have well-paying jobs or stable jobs, which is similar to the tenants we look for.
Exactly. And it's super cool that you always put the tenant first because then again, the tenant is the one that is providing you that income, isn't it?
That's exactly, and this is their home, right? That's a responsibility that we don't shy away from. This is where you live. You want to feel comfortable and happy and safely. At least I believe that about my house, right? It's a sanctuary. I don't want any negativity in my home. I want everything to be happy and positive because the world can beat you up outside. And then when you come home, that should be your safe space. And so we really try to do what we can for our residents. And we want to make sure that they want to tell their friends about living there too, because that's how you get great referrals too on the investment side. It's a strategic move as well.
Oh, that's a really good one, actually, because you don't have to be interviewing that many tenants anymore.
No.
Wow. And now when it comes to the amount of units, because you mentioned that you're investing in like 200 or so units.
200 and up.
Oh, wow. That's a lot. But for a beginner, how many units would you recommend them to start looking at?
So I always say go big or go bigger. So
love it.
I don't think that anyone should be like, oh, I'm starting off. I'm only going to look at a duplex or a quad, which I know it sounds intimidating for me to tell someone who's never done this before, hey, go after 400 units.
Oh, wow.
But the beauty of multifamily is really that there's so many partnership opportunities. And real estate in general, it's a team sport, right? Like we all collaborate with each other. We work with other partners in various capacities. So what I would say instead is find your strength, find your skill, find someone who complements you that's been doing this and go and add value to their project. But start on a bigger scale. There's no reason why you need to start at a 10 unit or a 20 unit. You can start with a 200 or 400 unit asset. Just find the right person that you want to partner with and bring value to them and do it that way. That would be my recommendation.
And what are some of those skills that you would say someone could have as a beginner investor? Yeah,
so there's like three main slices of the multifamily pie, right? You have your acquisitions, which is finding the deal, putting it under contract, stacking the capital, negotiating, et cetera. Then you have your capital stack, which is how are you going to pay for it?
Right.
That's either raising capital from investors, bringing LPs to the deal, stacking debt, bringing pref equity, whatever that looks like for your model. And then the third is operational. So once you close the asset, then the hard work begins, right? Because you have to execute on the business plan that your investors are expecting to make a return from. So once you close, you want to start operating the asset and you want to make sure that you are able to asset manage. And if you're doing in-house property management, manage the asset and the property management side of the deal. So those are like the three buckets. I would say find whichever one is most interesting to you and then find someone who has the other two skills and come together.
Complement each other. That's amazing. Yeah, it's super cool how like in multifamily, you truly get to see that team that truly supports you. And it doesn't matter if you don't have as many years of experience as your other partners, you're still going to be successful because you have them together.
Team sport, I'm telling you.
Go team multifamily. And now we are living in some sort of crazy times right now. And especially for the real estate area, especially for single house, it's kind of difficult to actually get into contract with a regular home. But what would you say is the situation for multifamily?
The same. It's really hard to get assets under contract for multiple reasons, right? So we're in 2022 right now, and we've just come out of a global pandemic. And in 2020, there was a lot of capital that was sidelined because they could not deploy it for whatever reason. You know, they couldn't walk assets. Their mandates didn't allow them to acquire those assets, whatever the reason. Though that capital is still trying to find a home so it can generate returns. So that's one. Two, tax rules are changing with regards to bonus depreciation. This year is last year. We can take 100% bonus depreciation, which is huge on multifamily assets. It's very tax efficient and tax effective. And next year that goes down to 80%. And then the year after goes to 60, then 40, then 20 until it phases out. So right now I feel that there is a lot of capital seeking the tax efficiency of multifamily. And lastly, real estate in general, income producing real estate in general is a great inflationary hedge. And we've all seen what the inflation reports are that are coming out, and it's not good. And so this is a great way to hedge that capital that you have. And you don't want to keep money in the bank right now because it's not going to make you any more money. So that's generally why I think we're seeing so much demand right now. So it's very similar. Now I'm starting to see the market soften a little bit. So maybe instead of having 40 offers, we'll have like 12 offers that we're competing against. But, you know, it's been a hot market. I think multifamily is going to continue to do well in the near future, at least. And then I hope that it starts cooling down so we can buy more assets.
What are some of the strategies that you guys have been implementing during this time? Yeah,
so like I said, we've always been investor first. And I think that's really helped us through these more uncertain times. It's allowed us to trade on assets that we maybe wouldn't have been able to do had we not put investors first and maintain that laser focus. The other thing is we look at more deals now than we did before. So at one point we maybe looked at 100 deals before getting one. Then it went to 200. Now, you know, it's like 300-400 deals before we are seeing even one deal. We don't want to change our underwriting metrics because, like I said, it's garbage in, garbage out, right? So what we don't want to do is put ourselves in a situation where we can't deliver on the pro forma returns that we're projecting to our investors. So I think those things are really keeping us afloat and keeping our assets turning out good returns for our investors.
That's incredible. Then again, it's super cool how like in multifamily, there's so many different strategies that you can always use to deliver the exact performance and like numbers that you were already projecting.
Yes. So. Yeah. And actually in that same vein, it's another thing to keep in mind, especially at this point in the market cycle, is you want to have multiple exit strategies, right? So you want to know, can you hold this asset for 3 years and exit? Can you hold it for 5 years, 7 years? What happens at year 10? Can you recap the deal and take your investors out so you've de-risked them? Can you add supplemental financing? Are you going to just sell it? Is there a 1031 exchange opportunity? So there's so many different ways that you can look at the exit. And once you start getting into multifamily more and more, these words that probably sound like Greek to most people will get a lot less complex and a lot less intimidating because you'll understand the structure of deals better.
Thank you so much again, Veena. Yes. And thank you to our audience. And we are super excited to start investing into multifamily. Thank you so much for helping us understand all of the 4 tips that we need to start investing right. Thank you so much to our audience, and we'll see you in the next episode. Bye-bye.